and welcome to the meeting of the CNBC TV18 Citizens Monetary Policy Committee. As always, on the eve of every monetary policy, this Citizens Committee meets to deliberate on what the official MPC should be doing. We have with us Chairman Pranab Sen and members Sonal Verma, Managing Director and Chief India Economist Nomura, Soumyakanti Ghosh, the Chief Economic Advisor to State Bank of India, Sajid Chenoy, Asia Economics, JP Morgan, and Samiran Chakrabarti, Chief Economist, Citi. Well, the growth inflation context has clearly changed. The second quarter GDP numbers have shown an upturn, but CPI numbers may also see an uptick given the sustained increase in crude and global metal prices as well. In fact, global growth also appears to have surprised on the upside. With these preliminary observations, let me delve into the discussion. Welcome, gentlemen and lady. Dr. Sen, as always, let me start with you first. How would you read the second quarter GDP number and as well put it in context with the recent uptick in prices as well?
Well, you know, as far as the second quarter is concerned, it has to be seen in the context of the first quarter. In the first quarter, you know, we do know what happened. It came down. There was a destocking issue. We knew the destocking was going to get sort of overcome in the second quarter. That showed up in manufacturing. The problem, of course, is we don't know, you know, where we are on the cycle, because we are still essentially jumping up and down on a fairly unpredictable trajectory. So we still need to wait and see, at least for the next 2 quarters, where we are going and how things are heading. The investment numbers still don't look good. You know, 4.7 growth may be exciting, but seen against GDP growth of 6.3, you're still sequentially getting a lower GDP investment to GDP ratio. So all of that means that we are in a very uncertain zone even today.
All right. Well, let me come to the gentleman with me here in the studio. Samiran, you know, the growth looks like needs less support now, would you say, given the way in which the GDP numbers have turned out?
Well, in our assessment, it's a pretty nascent recovery at this moment. We have had significant slowdown in growth for 5 quarters, so we're just recovering out of that. I don't think we need any particular stimulus at this moment, but at the same time, we should ensure that there are no more headwinds coming, which will kind of derail the growth process at this moment. Let's face it that global growth it cuts both ways. While it helps us increasing exports, at the same time, we have to be worried about the commodity price impact coming out of it. So from that perspective, we have to be much more careful. We have just done significant structural reforms. These structural reforms often have short-term costs associated with it. So we possibly might see a little bit of that still lingering on in the system. And whatever little of third quarter data we have seen, that has been a bit tepid. So we have to keep that in mind as well. So I would say that it's a time to be a bit cautious on growth rather than
optimistic,
rather than showing a green flag and saying that everything is fine.
Okay. Well, Sonal, let me get the global context as well in. Do you think the global growth is extremely positive? What should we expect in terms of rate cycles as well as global commodity prices? What should the MPC worry about?
Well, the global growth front is definitely looking, one of the best we've seen in the last 6-7 years now. And most projections for 2018 are that this global synchronized recovery that we've seen for the last 12-18 months will actually continue. So the growth outlook is quite positive. Fortunately, for emerging markets, inflation is still under check. So we are in sort of this Goldilocks zone for emerging markets in terms of capital flows, still continuing, and the pace of monetary policy normalization also being gradual. So in this backdrop, and the world that we are stepping into in 2018 as of now does appear like this Goldilocks kind of a scenario can continue for the foreseeable future, and a bit of policy normalization, continuing from the Fed on both rate cycle and on the balance sheet normalization. The European Central Bank, we think, will announce, a tapering off its asset purchase program mid-2018, and we have a lot of other, global central banks also normalizing. If we look at more regionally, actually, Korea is one of the first Asian central banks to actually join the Fed-led normalization. And the cues we are getting from other central banks in the region, is that Malaysia, Philippines, Taiwan, a lot of these central banks actually will be also gradually hiking interest rates in the next 6 to 12 months. So that's the global backdrop we are getting into. It's very different, from the backdrop we've had in the last, 2-3 years. And from a commodity price perspective, of course, it suggests that there's still demand, and perhaps, stable commodity prices around current levels should be the baseline that we work with.
Okay. Well, clearly the global scenario has changed. I don't know how many will agree that the inflation trajectory is as steep as Sonal is making it out. But that question to you, Sajid, how worried should we be about inflation? I'll come to growth as well.
Yes.
But inflation?
Lata, so I think, since the last review, all the inflation risks have moved in one way. Oil prices are now 12% higher than they were when the RBI last met. They're 12% higher than what's presumed in the RBI's inflation forecast. You saw some unseasonal increase in vegetable prices. Global commodity prices, metals have gone up. But I think most importantly, if you look carefully at core inflation, and this is not trivial because you've got to adjust for petrol, diesel, housing, what you see surprisingly, or at least at the time, was that core momentum both in September and October was quite steep. Prices went up 0.5% month-on-month seasonally adjusted, right? This was not GST related because the GST impact was July and August. Now that makes sense. If you look closely at the GDP numbers that came out, the headline understates the kind of recovery in the private sector. Adjusted for agriculture and government spending, we've gone from 3.8% in the first quarter to 5.5% to 6.8%. So now the pieces kind of add up that India's domestic recovery is nascent, but is occurring, maybe a little more strongly than the headline numbers suggest. That in conjunction with the pickup in commodity prices and oil prices is forcing producers to pass this on. So either pricing power is picked up or you're being forced to pass on these input price increases. What all this means is November CPI will likely come out higher than 4.5. December could be at 5%. And the first quarter of next year could now be closer to 4.8, right, which is above the RBI's forecast. And most of next year, I think, will be between 4.5% and 5%. Even if you net out the 40 basis points from the HRA allowance, what that tells you is underlying inflation is close to about 4.5% in the first quarter, number one. More importantly, this is not vegetable induced. If you look, for me, the core is the key here. That the fact that core momentum has gone up means core inflation will be above 4% in the correctly measured in the first quarter of next year. So I think this becomes a relatively straightforward meeting for the MPC. It's been a tricky year, but now all the forces are moving in the same direction. Global growth is solid. India's growth is following suit, albeit slowly. Commodity prices are picking up. Core inflation is picking up. Fiscal risks still linger up. All this argues, for policy to behave in one particular way, which is to stay on hold at the moment.
Actually, you and Sonal are almost giving me the impression that it's time to hike. But I guess that's, we'll come to that in a bit. We'll make you all vote.
Way too premature. Yeah.
Soumya, I wanted the fiscal picture. One of the big problems that the MPC bothers about, will we see a fiscal slippage? How should the MPC add up those numbers?
See, in terms of the fiscal, I think there is a lot of, consternation in the market in terms of a possible fiscal slippage. But I think even though a part of this may be justified given the numbers the way they have come yesterday, 96% of the full year estimates, but beneath the numbers there lies some trends which the market, which all of us should pick up. The first thing is that if you look into the small saving collection, yesterday the total numbers came in at 77,000 crores. So that is from April to October, and that is 15% higher than 66,000 crore last year. So at this rate, it is likely to be much higher than the 1 lakh crore budgeted. If that is the case, then the government will be able to buy back that 1 lakh crore of securities, of which already did 28,000 crore a day before. And I think that is the should be the crux of the market sentiments, because at the end of the day, if you are able to buy back the securities and keep the net borrowing number at 3.5 lakh crores, which it has targeted, I think then the market should take a soothing point of, even though I believe that the fiscal deficit number could be a tad higher than 3.2%. But having said that, I think the government will not be too much waver on the path of fiscal consolidation, because next year the fiscal deficit target could actually then be that much steeper. So I think that the government may actually keep the deficit a little higher, but then go down from that level or keep it at the same level for the next year, at least the election is over. So in my sense, I think the market should look very closely at the net borrowing numbers, because at the end of the day, that is one thing which is going to have an impact on the yields, which are currently at higher levels than what market fundamentals warrant.
Okay. Well, I still have to get Saviren's view on inflation. And I have to get your views on liquidity. We have to take a quick break, but all those questions and deliberations with the Citizens MPC in a minute.